So when you've revised all your qualitative characteristics and accounting principles, you've got 13 different theories telling you to do 13 different things. And while some of them are related, so for example, relevance and entity are very closely related, reliability and historical cost are closely related, some are in complete conflict. So for example, what's often relevant is completely unreliable and vice versa. So how do we know when to use which one and also which one's right? Well, the first thing to remember is there is no right answer. It's all dependent on the question. If you get asked about a specific theory, you apply that. If you get to form your own opinion, you apply whichever one you think's right. So what if you got a question where it said, Janet owns a business that bought a vehicle for $8,000 5 years ago. This week on carsales.com, she saw a similar vehicle being sold for $6,000. Her sister needs a car urgently and has offered to pay $8,200. And the vehicle has always been valued at its original cost of $8,000 in the firm's books. So what is it? How should it be valued, this car? What's the right answer? Well, there isn't one. It all depends on the question. If we're applying comparability, we'll keep it at the $8,000 it's always been listed at. If we're valuing it at consistency, we'll do the same. It's always been valued at $8,000, so to be consistent and apply the same methods, we'll keep it at $8,000. If we're applying historical cost, we'll do the same. Relevance, however, we'd probably use the one that's most important for decision making. It looks like we've got a firm offer here from our sister, so we'll probably end up selling it for that. So I think it's reasonable to factor that amount into our decision making. Reliability, we're going to choose the amount that is we can prove with a source document, and that'll be the $8,000. We should have a document from 5 years ago to back that up. And conservatism, well, conservatism says use caution, recognize an expected loss. So in this case, we're expecting its value's gone down. We better record that. On the flip side, it also says don't recognize a gain until certain. Maybe I end up selling it for $8,200, but the point is until that gain's certain, I don't record it under conservatism. So the main thing that this demonstrates is there's no right answer. These theories often contradict each other. Some support each other, but a lot sort of tell you to do one thing, and in contrast, another theory tells you to do something completely different. So looking at some of the topics where there might be a conflict between the qualitative characteristics and accounting principles, are topics like, should you depreciate assets? So on the one hand, relevance and would say to definitely do it. That'll help our decision making, as in we'll be able to calculate an accurate profit and make good decisions from it. Also, if we've always depreciated something, then we should always continue to do it, and comparability and consistency tell us to do that. Another theory that says we should do it is reporting period. That's all about matching revenues and expenses for the period. Well, depreciation's an expense, so under reporting period we should do it. On the other side, reliability says no, you should never depreciate something. Why? Because there's a lot of guesses. You're guessing how long it'll last, you're guessing the residual value or the rate of depreciation, and therefore we shouldn't do it. What about writing down assets to their net realizable value, such as stock? Yes, on the one hand, we've got relevance, as in it'll help us make decisions on how to sell the stock if we write it down to its lower amount. Also, to be conservative, we'd recognize an expected loss. On the other hand though, reliability says no, the net realizable value is always an estimate. It's not a figure that we've got any proof for, so we should keep it at the purchase price. So historical cost would also back that up. One's not more right than the other. It also depends on your personal opinion, but it just demonstrates that how the theories can be in conflict. Consistency, well, what did we always value stock at? If we've always valued it at its cost and we're going to start writing things down now, well, we'd breach consistency. However, interestingly enough, what if we always write stock down? If we always write stock down, well, all of a sudden consistency says I should keep doing that. So that's where one theory actually conflicts with itself. What about, can non-current assets of very small amounts be written off as expenses up front? So for example, I buy an office chair with a cost of $50 that's going to last for 10 years. Can I just call that an expense up front instead of calling it a non-current asset? It's such a small amount. So I think you could do that under relevance. Whether it's an expense or an asset, it's only $50. It's not going to affect your decision making. However, reporting period would probably disagree. You should match the amount of the chair used every year in the period in which it was actually used. What about lastly, should you even do a budget? So budgeting is a really important topic for us. Should we actually even be doing it? Well, on the one hand, to be relevant and make decisions, you definitely need to do budgeting. But on the other hand, it's completely unreliable. And that's because a budget is all guesses. And we know that reliability says we never guess without source documents. We should have something to verify every single number. Looking at a specific question, this is from 2012. A business bought a photocopier 2 years ago, and here's what happened. In the first 2 years, they depreciated it using reducing balance. And then they got a note from their accountant which said, in the third year, can you start depreciating it using straight line? And the question you were asked was, it was discussed, so a big one. Do you agree with this recommendation? And the problem here is the accountant's basically wrong, because on the one hand, straight line's used when we have assets with the same revenue earning capacity, and reducing balance is used when assets earn more revenue in their early years than they do in their later years. Now personally, I think a photocopier fits in that category. However, that's how we've been depreciating it. The accountant says, can you switch to this method? So clearly the accountant's got it wrong, but because this is a discuss question, I've got to find an argument to try and back that accountant up. So to do that, I guess I've got to say the accountant must be assuming that if it should be done straight line, a photocopier must earn the same revenue every period. Personally, I disagree with that, but obviously that's what the accountant must think. So what are some theories that say, yes, I should change? Well, I guess one would be relevance. If I think a photocopier is actually only going to earn the same amount of revenue, well then, yeah, I should definitely change to straight line. That'll make a better decision or help make better decisions. Also, reporting period. If I think that more accurately reflects the expense for the period, well, that's what reporting period says to match against my revenues. On the other hand though, comparability and consistency say the opposite. If I've used reducing balance in years 1 and 2, well, I should keep it in year 3. No matter whether I think straight line's better or not, it doesn't matter. Under comparability and consistency, I'd keep depreciation the same for all 3 years.